Hi everyone, Shab out with another video. Today I'm going to be talking about Caterpillar, the market leader in construction machinery and industrials, dividend aristocrat, excellent long-term returns, released Q4 results on market open Friday, down 6% for unknown reasons. I'm going to delve into the report and then the financials and do an intrinsic valuation calculation with the DCF to calculate a fair value on what I'd be willing to pay for the company. So I was reading through the financial reports on Friday to just check what is the problem here. Why is this company down pre-market? This is a company that I tend to follow anyway because I think it gives a good idea of what's happening with the economy and infrastructure building and things like that. And also, it's just a stock that I have on my watch list that I'm quite interested in. From my point of view, financial results are actually really, really good. 23% revenue growth, albeit on slightly weaker comparisons, but we can forgive that because 2020 is a very weird year. 23% growth for this company is very strong, and in this industry is also very strong. Slight operating margin loss, but I actually see this as a win considering the current macro environment. It's just a bit ridiculous with inflation and supply chain crunches. So a slight loss in operating margin for a company like this, which is very inventory and material heavy, that's not so much of a concern to me. Profit per share up 175%. Again, last year was kind of a weird year for this, so I'm not going to give it too much for that. And adjusted profit per share up 27%. These are all excellent. A solid return to form for Caterpillar, company that's been a bit all over the place the last few years, but I think this is a really good return to form and a very, very bullish sign. I can't really understand from this why the numbers are going down, but we'll delve into that a bit more in a minute. And here's some graphs from the report just to again illustrate a bit further how strong this quarter was. So Q4 2020, 11.2 billion in sales compared to 13.8 this quarter. Excellent return to strength. Operating profit was still up, although the margin was restricted a bit, and adjusted per share profit up again. This is a strong company that's starting to get back to its true strengths. So again, I'm really not seeing the problem here. So I'm looking around in this report for a reason for the stock to drop, and it's clear that the guidance is the main reason. Sales expected to be strong in Q1 versus 2021, so I'm not really seeing a problem here. Continued strong end user demand and favourable pricing dynamics. The key reason here, which I think the stock has declined by 5%, aside from the general malaise in the market and poor market environment for companies releasing earnings, is they expect headwinds to adjusted operating profit margin in Q1 2022 versus Q1 2020. Margins to improve throughout 2022. To me, this is kind of ridiculous for a 5% decrease in my opinion. They recognise that there's going to be a slight margin loss, but they anticipate price increases to offset the manufacturing costs, and they think overall the margins are going to improve throughout the year. For me, this is an overreaction. No red flags here. Restructuring costs are reasonable. CapEx is reasonable. Global tax rate, these are all reasonable to me. No red flags. A solid report. If anything, I would have expected a 2 to 5% upswing in the stock today from reading this. So let's have a look at the balance sheet and delve in a bit more and see if there's any more red flags with this company, or is it a solid investment. Looking at the balance sheet, financially, Caterpillar is just okay, as an okay balance sheet. Has $9.3 billion on the balance sheet in cash. Cash debt ratio of 0.26. This is a highly levered company. Not a great number for the industry, but versus Caterpillar's history, it's actually improving this, and management are paying down debt at a reasonable rate. The high debt is reflected in the Altman score of 2.86, indicating that this is just an okay debt situation. This is kind of in the grey region of the Altman score. It's not an immediate risk of being in financial distress, but it's definitely something to be aware of when you invest in a company like this. But this is a company that is involved in heavy machinery, has a lot of CapEx, has a lot of costs. Debt is to be expected, and when they build factories and things like that, debt will be taken on. And also, less encouragingly in the past, they've taken on debt to continue paying out the dividend, which I'm not a fan of at all, but they've really righted the ship. And the reason they've righted the ship is because of their excellent profitability ratings. For industrials, a 10.64% net margin is absolutely fantastic. Operating margin of 13.73%, again fantastic, very strong for the industry and very strong for Caterpillar's history. Return on equity percent of 32%, absolutely outstanding, very, very strong for the industry, good for Caterpillar's history. Return on assets percentage of 6.46, again strong for the industry and very strong for Caterpillar's history. This is a company that really is performing the best it has been in a long time. Net margin of 10.64%, really excellent, I can't bring that home enough. Takes home 10.64 cents for every dollar in revenue. This is a strong company, and this allows a degree of I'll let it off with a not great balance sheet, because I think they will. They are fine on interest and they will pay down this debt over time, and this is a company that continues to return profits to shareholders at a good rate, so they're not overly concerned about debt, nor am I. Looking at some basic valuation metrics, there's a PE ratio of 21 and a forward PE of just under 16. These multiples are below the S&P 500 average at the minute. This indicates it is discounted versus the market and may present a reasonable entry point. Price to free cash flow of just under 20 is about as cheap as Caterpillar has been in recent years. Price to earnings growth of 1.72 is also some of the lowest in recent years. This is a company that is traditionally richly valued due to its status as a dividend aristocrat. As many dividend aristocrats are, they typically trade PE of 25 and above, as you'll see for like Coke and Pepsi and things like that. Seems this is no longer the case. Forward PE of 15 or 16 is some of the lowest that I've ever seen in Caterpillar's history, and a current PE of 21 is probably the lowest multiple I've seen ever, and you can see that by the versus history number. I'm really quite happy with this at this price at investable rate. I just want to calculate a fair value and work out some margin of safety. To do this, I'm going to do a discounted cash flow calculation. So with the current stock price of $201, I'm using a growth rate of 10%. I'm using free cash flow for this analysis because the earnings per share data is a bit all over the place. And for a mature company, I actually prefer using free cash flow as a metric. Free cash flow 10-year average rate is 14.8% growth. I think this is perhaps a little optimistic given the size of the company, and I think 8.9% over the 5-year rate is perhaps a little under optimistic. So I'm going to go for a growth rate of 10% just to use an even number. I think it's probably going to be somewhere in between these. Add a discount rate of 8% for the long-term returns of the stock market and a terminal growth rate of 4%. This gave a fair value of $210.51, margin of safety of 4.4%. But we're talking, this is a stock basically trading at fair value, with 5% is neither here nor there. I consider this effectively trading at fair value, and this is thoroughly in an investable range right now because I consider 5% just to be within the margin of error. I think at these prices, $201 as we speak, Caterpillar is around fair value for investment. It's trading 18% off its highs, so we're talking, of course there's been better times, as you can see from the graph, it's been around 170 at some point. Of course there's been better times to buy it, but I'm not interested in that. I'm a long-term investor who's going to dollar cost average anyway. I think the tailwind of a potential multi-trillion-dollar infrastructure bill in the US is a huge tailwind for Caterpillar, and going forward, even if this bill doesn't pass, there will be infrastructure spending in the US in particular and in other countries. This is a clear win for Caterpillar in my opinion. Not just to mention that this is a company that doesn't actually need this because it's such a robust company, it's such a necessary company to the economy, that this company is going to do well in all seasons, as we saw it in Bill Gates' portfolio, because in his kind of all-weather portfolio. This is the type of company that you can rely on to pay solid dividends, to buy back shares at a decent rate, return cash to shareholders, and be around in 50 years in some capacity, most likely significantly larger than it is today. I'd be happy investing at these prices, so for me it's firmly a buy. I'm starting up a small position. Again, the current market environment is a bit weird, but I think to get a reliable company like this, it's quite hard to find companies of this pedigree, dividend aristocrats that are trading at fair value, so I think this is an absolutely golden opportunity for me with Caterpillar. But again, this is not financial advice, so please comment if you want in the comments and see if you agree or disagree with my opinion. If you want financial advice, you should go to a registered financial advisor, and please do your own research. With that, like and subscribe the video if you're enjoying. Thanks.